Budget 2021 sets in place a framework to fund long-term infrastructure with long-term borrowings. The Government Parliamentary Committee Chair for Finance, Trade and Industry says this is a shift from Singapore's past approaches, where expenditure was funded with current budget allocations or accumulated surpluses. Mr. Liang Eng Hwa also says it's key to invest in the future without drawing on past reserves. Brandon Tanoto with more.
There'll be a significant strain on Singapore's budget allocations if investing in new growth areas and long-term infrastructure like rail lines and assets that protect against rising sea levels is funded under annual budget cycles. Mr. Liang says deferring these investments until Singapore's finances are back in good shape isn't recommended, and so alternatives to generate revenue should be considered.
We have to move with times in the way we manage our government finances, but it's important to remain steadfast to the values of prudence and discipline, and to ensure that we operate on the balanced budget basis, and also to jealously safeguard our reserves so as to continue growing it for our future generations, just like what the past generation have said it for us.
As such, drawing from past reserves to fund economic investments should only be considered as a last resort. Mr. Liang suggests that borrowing to fund investments aimed at helping Singapore come out stronger from the pandemic is justified. However, strict caps should be set on such borrowings as a prudent safeguard.
Reserves are our emergency backstop, and we need to hold or grow the base amount to ensure a growing, if not a steady NIRC. Each time when we draw on our past reserve, it also means divesting a part of our financial investment, and hence we will lose out on the returns from these investments over the long term.
The investment returns from the reserves, also known as the Net Investment Returns Contribution or NIRC, form the largest contributor to government revenue. Singapore will tap on its past reserves for the second fiscal year in a row to pay for COVID-19 support measures, bringing the total draw to be up to $53.7 billion.